Greece, the spike in oil and gasoline prices, the earthquake in Japan, they're all supposedly reasons the economy has slowed in recent months. And maybe they are, as Fed Chairman Ben Bernanke so badly wants us to believe, transitory. Here to talk about them with me is Paul Hickey, co-founder of the Bespoke Investment Group. Paul, one of the great things about the work that you guys do at Bespoke is reminding us that we've seen it before. As much as this feels like a fresh round of economic challenges, we've looked at these things in the past. So remind us, when was the last time we stared at something kind of like this, and what happened?
Well, I mean, you took the words out of my mouth. I mean, we always hear that this time is different. We're in such a unique period of time. But when you go back, you can find similar periods. And just looking at this current period, we went back to 1995, the Kobe earthquake. And
the last time Japan had a big earthquake.
Well, yeah. It was a big earthquake. Japan's the third largest economy in the world. So when the economy goes to a standstill, it's going to impact.
And at that point, it was the second largest economy in the world.
Good point, yeah. So it is going to impact things in the U.S. And what we looked at is jobless claims and the ISM manufacturing, two widely followed indicators which give us a good read on the economy. And back in 1995, jobless claims, a four-week moving average, was hitting a multi-year low, and the ISM was hitting a multi-year high. Right when the Kobe earthquake struck, that they peaked, or jobless claims bottomed, and went up for about 6 months or so, and the ISM fell back. In the current period, the jobless claims actually peaked the day before the Japanese earthquake in Japan, and the ISM also peaked in March and have been pulling back. So, I mean, we think that it's more than just a coincidence that these two are happening in lockstep with each other, and it's going to cause temporary weakness in the U.S. economy. Now, going back
but the pattern in 1995 that eventually saw recovery.
Right. Well, yeah. Now, going back to 1995, we had a recovery in the economy. Things eventually, after 6 months or so, the data started picking up, and by that time, if you had waited for the data to pick up in the economy, the market was already well ahead.
But the underlying weakness in the U.S. economy today is much greater than it was back in 1995.
Well, there are other issues. I mean, in 1994, you remember we had the Orange County bankruptcies, we had interest rate, we had problems with interest rates, but to a much smaller degree.
Goldman Sachs almost went out of business.
Right. So we had a lot of these things, and in early May there were in the sell-off. We've had four major issues. We've had Greece, we've had oil rising, we've had the debt ceiling, and we've had the economy. Greece hasn't been settled, but it's going to be day of reckoning's been pushed out. Oil's come in 20%. That's going to benefit the consumer. And the debt ceiling, we don't have a resolution there, but you're beginning to see more and more that the sides are at least talking to each other, and something we think will be resolved. So the one outlier is the economy, which we think is more a result of Japan.
Okay, so you've made the macro case for an economic recovery in perhaps the not too distant future. What does it mean to an investor?
Well, to an investor, it means we still think there's a bunker mentality in the market here, where investors are so afraid of facing another sell-off. We've had two 50% haircuts in the S&P 500 over the last 10 years. So investors are rightly so worried that I don't want that to happen to me again. So they, whenever we see the slightest whiff of a sell-off, we get this feeling that it's all over, I should have sold yesterday. Whereas 10 years ago, we had this, whenever we had a sell-off in the market, it was a big buying opportunity.
Now, okay, big buying opportunity. Key question. Let's look at this chart right here. The two dips that we've seen since the beginning of the year have been, I think, respectively, a 7% pullback or a 6% pullback and a 7% pullback. So not a bona fide correction. And each time, or at least if you go back, each time we've hit a higher high. Do you think that's what's going to happen? That coming out of this pullback, we will hit a higher high, that we'll actually get to a bigger number for the S&P 500 before the end of the year?
We think we'll be at new bull market highs by the end of the year. We're not looking for double-digit gains on the year, a real big gain, but the market is undervalued relative to its historical PE, and we have such this negative sentiment where the pendulum 10 years ago, like I was saying, was every dip was a buying opportunity, has shifted to the other extreme, whereas every dip is, oh shoot, I should have sold yesterday. So and that kind of mentality, until investors or the pendulum shifts somewhere in the middle, it's going to make us, we're still on the side of being bullish on the market.
There are always good lessons to be found in history, Paul. Glad you explore them at Bespoke, and good of you to join us here in the Inside Track.
Thanks, Erik.
Paul Hickey, the co-founder of the Bespoke Investment Group.